little bit of background. Barbara is a senior economist in the Research and Economics Department of REIS and responsible for the firm's marketing, forecasting, valuation, and portfolio analytics services. She has written all kinds of amazing things on the impact of Brexit on commercial real estate, impact of store closures on retail rents, and many, many more. If you check her out on the REIS site, you'll see tons of great white papers and other publications. And so we're really grateful that she spent an hour with us today to give us some insight on the office market. So with that being said, I'm going to turn it over to you, Barbara.
Okay, thank you, Carl. Can you hear me?
Loud and clear.
Okay, great. Well, thank you for having me. As Carl mentioned, I have an office market overview that I'm presenting today, and all of the data herein is from REIS or from the usual government agencies. Our agenda today is to start on the bigger picture, the macroeconomy, and specifically on the jobs numbers, the most recent especially. Then we're going to focus right in on the office market, look at demand and supply, occupancy, rent growth, look a little at the metro level to see which markets are doing better than others, and then really look at what's really going on in this expansion. That is how net absorption per added employee has really slowed compared to previous expansions. And I do that at a national level and for a number of metropolitan areas. Then we'll look at some cap rate spreads and some office cap rates by region. And finally, just touch upon how the current political climate might be affecting commercial real estate or not. So let's start with GDP growth. So as you can see here, this shows GDP growth, the quarterly growth rate, and we don't have Q1 2017 numbers in, but you can see there's been quite a slowdown in 2016 compared to previous years. I mean, the overall theme of this expansion seems to be 3 steps forward, 2 steps back. We're growing, but we're growing at a rather slow rate, and that's not necessarily due to the consumer. As you can see on the bottom chart, this is consumer spending, the annualized change by quarter. And the consumers are doing very well. It's some of the other variables. Investment has been very volatile, government spending up and down, net exports not necessarily helping GDP growth. So there's a lot going on in the economy that it's hard to get a finger on, mainly because the consumers are doing their job in growing the economy. Right now, the first quarter 2017 outlook looks for more muted growth. The current economy.com high-frequency forecast is for just 0.8% annual growth, which, as you can see, is pretty slow, although, as you can also see from the GDP bars up top, the first quarter tends to be the slowest of the year, especially when weather is a significant factor, as it was in March. It wasn't necessarily in January, February, but we did have a pretty severe March that we also show an impact in the employment numbers. But the good news is that usually bounces back in the second and third quarter. So a one-quarter weak performance shouldn't cause too much for alarm. As an economist who's worked in commercial real estate for more than 20 years, I don't even pay attention that much to GDP. I really strongly look at labor markets and specifically job growth by sector. And as you can see here, we're seeing a similar story. 2014 was very strong, and growth has somewhat ebbed since then. So it's never been a really flourishing, thriving recovery. That's just been the theme of this entire expansion. As I said, 3 steps forward, 2 steps back. 2 strong months of employment job growth in 2017, followed by one rather weak one in March. As I don't want to say depressing, but as what's the word I want to say? Subdued as this looks, I don't think it's that unhealthy. And that I mean that the reason why the markets have not gotten over speculative, or we don't have too much over investment, is because our growth has been so slow. And I think this is a healthy, steady job growth rate and a GDP job growth rate for the long haul. We don't have the bubbles that we had in the prior 2 expansions. So even though this looks underwhelming, I don't think we should worry about it so much. I think it's pretty healthy. What I like to do is really focus on job growth by metro, because as you know, the national employment growth rate or GDP growth rate is an aggregate average. And when you look at the top and bottom metros, you see that some are doing far better than others. So here we have the top 12 and the bottom 12 metros in terms of total employment growth for the last 3 months, December of 2016 through February 2017, over the same period in the prior year, which is December 2015 through February of 2016. And you can see the top metros there are all, not too surprising, very geographic: South, West, and Texas. So you have Dallas, Orlando, Nashville, Atlanta, Jacksonville, very, Charlotte, Seattle, down to Tampa. No metros from the Northeast, no metros from the Midwest in any of those. They're all doing pretty well in most industries. On the right-hand side, unfortunately, you have the bottom 12, and including, 8 metros there that have lost jobs on a year-over-year basis. Tulsa, Fairfield County, Milwaukee, New Haven, Wichita, Oklahoma City, New Orleans, and Rochester. Most of those aren't too much of a surprise. These metros have largely trailed. In Fairfield County in particular, they've lost a tremendous amount of jobs ever since GE Capital decided to uproot and move to Boston. It was a big employer there. Most of these others are very small metros that aren't having a major impact on the national growth. Moving into the office employment, this paints a slightly different picture in that most of the same metros on the top 12 list were on the top 12 for the total employment growth, particularly Charlotte, Charleston, Nashville, Atlanta, Dallas, Orlando. It's on the right-hand side. We see the bottom 12 are all losing jobs. So there's more of a divergence between the top metros and the bottom metros when you're looking at the office segment of the economy. But still, it's very much the same metros that you see on both sets of lists, particularly at the top, Fairfield County, again, because of all those GE Capital jobs and a number of hedge fund jobs. And a lot of the ones on the right-hand side, again, from the south, but you have Seattle and Phoenix, and you still have the tech markets driving a lot of growth in some of these areas. Now, moving into the office sector itself, we like to start out with this chart. This shows supply and demand trends over time. And we'll take a little bit of time on that just to see what the trends look like now compared to previous expansions and recessions. So the blue lines there, the dark blue lines, represent completions or new supply. The light blue bars represent net absorption or demand. And you can see throughout this expansion, net absorption has exceeded new supply each year or each quarter. And we've seen vacancy rates decline ever so slightly since 2010. But as you can see, these bars are pretty low compared to previous expansions when net absorption in a single quarter was over 100 million, or excuse me, a single year was over 100 million square feet. So again, this expansion has been very subdued, but it's been healthy in that all of those light blue bars have exceeded the dark blue bars. Moreover, we can say with great confidence that looking forward, there is some more construction coming online in the next 2 years, but it's a healthy amount, and it's nowhere near the high levels of new construction we saw in the late 1990s, the late 1980s, and the early 2000s. So we may see a bit of an uptick in vacancy rate in 2017, as you can see the dark blue bar exceeding the light blue bar, but that's only a slight uptick. And then further out, net absorption also is expected to stay on par with where it was in 2016, and construction is just about the same rate. So the vacancy rate should hover somewhere between 15.5% and 16%. Nothing too startling, nothing too worrisome, but it's more or less what we've seen in the past, and it's healthy, and the construction isn't too high. Looking at the numbers themselves, you can see in this large table that office effective rents and asking rents have slowed in terms of their rate of growth. So at the end of 2016, office rents increased only 0.3%, and the effective rents increased only 0.4%. That trend is what we're seeing right now with the first quarter numbers, very slow rent growth. Again, this is because vacancy rates have not really fallen too dramatically. On an annual rate, the office rent growth was 2.3% and 2.4%. Now, we show in our forecast a little bit of an uptick from these rates, but not too much. So again, vacancy rates could fall to 5.5%, but rent growth should stay on par with what we've seen over the last couple years. Looking at the top and bottom office markets, this chart kind of combines all of the office statistics. It's effective revenue per square foot, percent change from 2015 to 2016 in the fourth quarter. This takes net absorption or occupancy growth times effective rent, and it shows the percentage change. That's what effective revenue is, effective rents times occupancy growth. And you can see based on that measure, the top 5 markets there are Oakland, Seattle, Atlanta, Dallas, and Phoenix. These are the markets we saw on the office employment chart at the top as well. So you can see how much the office market is tied to office employment growth. Some of these are much better than others. And in fact, the green lines and the red lines on this chart represent the top submarket and the bottom submarket. And you can see even in the better metros like Atlanta, Dallas, and Phoenix, there are some metros that saw an effective revenue per square foot decline. So most of the markets still did pretty well. The overall U.S. aggregate effective rent growth was 3%, and only 2 metros had a loss, Tulsa and Houston. You can see even in the bottom 5, though, the bottom 5 metros, only 2 had a loss. And Houston is no surprise to many people, as you know, the oil industry has had a pretty big impact on Houston. I can say about Houston that the reason why it didn't make any of those top or bottom charts in the employment is because Houston actually started to see job growth at the end of 2016. So I do believe that Houston, which was hurting throughout most of 2016, is on the rebound, and we expect to see positive rent growth in the Houston market. So moving on to what's really going on in this office expansion, I worked on a paper, I don't know if many of you have seen it, it was called The Shrinking Office Footprint. And what I look at is the trend in net absorption to office employment growth on a quarterly basis and an annual basis going back to 2000. And what I've seen in this expansion is office employment growth has been healthy, just as, if not more healthy than in previous expansions, but we're not seeing the same bounce in net absorption. Why is that? Well, as you can see in this chart, the blue in the bottom chart here, you see net absorption per added employee in the prior 2 expansions as well as the prior 2 recessions. And as you can see at the end of each of the prior 2 expansions, the net absorption numbers really soared. So tenants were very, very confident that better times were ahead, and they overleased space. But what happened in the subsequent recessions is they weren't able to shed that space. Of course, you can fire employees willingly any day, any time, but you can't get out of your contractual obligations on your leases. So a lot of tenants were stuck with a lot of office space, and they kept it throughout the recession because they had to. And then when they finally started to expand in 2011, they had all that extra space in their inventory. And as they were adding jobs, they were just filling that added space. We call that shadow space. And that shadow space lingered on the market through 2013. We finally see a jump in net absorption per added employee in 2014, 2015, and 2016. And you can see it's growing almost every quarter. So the good news is we've gotten rid of all the shadow space. That's all filled. But the long-term structural shift is with us. And by that, I mean that this trend of concentrating employees in smaller spaces and allowing more people to work from home means that the square footage leased by each firm per employee has shrunk, and it will stay this low probably for the foreseeable future. Millennials have gotten used to this, and while we do think the trend will continue to go up as millennials get older, after all, office space is a perk. It's an amenity that a lot of people still prefer. We don't see it jumping to much higher levels than, say, 150 square feet per employee that we saw in previous expansions. So my point is, we will see a reversion to trend in that square footage and net absorption should be more in line with office employment growth than it had been, but it's never going to be the buoyant market that we saw in the 90s and early 2000s. Now, I'm sure if you looked at this and you say, I wonder what my metro looks like. I've put together a number of slides to show some of the major markets what this trend looks like on an annual basis. In New York, believe it or not, the market responded in a more healthy way in the last recession. You can see the negative net absorption per lost employee was actually pretty high, meaning somehow a lot of tenants were able to shed their space, or maybe they just went out of business and the landlords just got it back. And the net absorption per employee in New York has stayed close to 100 throughout this expansion. So New York is somewhat the exception, and Boston has been as well. Boston's one of the healthier office markets in terms of this measure, even though they probably had a lot of shadow space, given the fact that they absorbed a lot in the previous expansion and shed less than that in the recession. Looking at a couple other metros, these are two large cities who were really, really plagued with shadow space in their expansion. Los Angeles and Chicago, you can see how low net absorption was in 2012 through 2014 in both of these major cities. Obviously, things started to bounce back in 2015 and 2016 in both metros. So again, this shows very clear evidence that all the shadow space that was plaguing the markets here was finally filled by 2015. Looking south to Dallas and Houston, we are seeing very similar, or I should say very different trends in these metros. Dallas is obviously one of the healthiest metros, if not the healthiest in the U.S. right now. The job growth is the top. Net absorption is very high. Rent growth is high, but it's not soaring. And of course, we have a lot of new construction there, but we also have a lot of corporate relocations. So net absorption there has been very healthy and on par with job growth, at least in the last 2 years. But you can see in the early years, there probably was some shadow space. Houston was soaring in 2014 and 2015, but almost to a level that was probably unhealthy in that it incurred negative net absorption in 2016. Obviously, the collapse in the oil markets really affected Houston far more than any other economy or major economy in the U.S. Certainly didn't affect Dallas like it had in the past. I know Mountain Seat is based in Atlanta, so I put up Atlanta here. You can see Atlanta has not had really strong net absorption. You know, it's averaged about 50 in this expansion. That's not really that strong. But Atlanta was slow to get out of the gate in this expansion. They suffered disproportionately more after the housing crunch. So even though they had a pretty good 2011, their economy has not been as strong in most of this expansion, but we're starting to see that really, really accelerate this year in 2016 and even early 2017 as their job growth rate has been healthy. So we do think net absorption in Atlanta will start to improve. Seattle is your typical tech market. They've added a lot of jobs. They've added a lot of new construction. And they're still relatively a low rent tech market compared to, say, San Francisco and New York. But they are one of the healthier economies in terms of job growth, and they have been throughout this expansion. So moving on and shifting gears significantly, I know a lot of you are interested in cap rates. So I'm looking at the office cap rate by region. This is the 12-month rolling average for office transactions. Now, when we put up cap rates, we provide the usual caveat, which is cap rates are subject to considerable selection bias. By that I mean the cap rate averages are driven by the transactions that traded that quarter. And when you break it down by region or even by metro, you can see a lot of volatility because some quarters, a large Class B office building will trade for a very low price, and that will boost the cap rates, or in the next quarter, a very high-end property will trade, or 2 or 3, and that will really affect the up and downs of the cap rates. So that's why we use the 12-month rolling average, but we still see considerable volatility. The black line there represents the U.S. average, and that you can see why that's in the middle. It's a blend of more markets, so that's why it's smoother. The smaller the region you're covering, the more the volatility. So by and large, even though there was a lot of uncertainty in the fourth quarter of 2016 with the new election and the call to raise Fed funds rates, there wasn't that much of a change in the overall office cap rate. It fell just not even 10 basis points, 20 basis points in the quarter. And we'll have our first quarter data out in less than a month, and it'll be interesting to see how the average cap rate performed in the first quarter. But, we also caution that there's not this strong correlation between quarterly changes in, say, the Fed funds rate and the cap rates, mainly because, again, the cap rates are driven by the transactions that traded that quarter, but also because a lot of the cap rate is in the denominator we have the price, which is what the buyer is willing to buy, but in the numerator is the net operating income assumptions. And sometimes when people think that the economy is getting better, the net operating income will go up as much as the denominator or the transaction price. So that's why we're not cautious that there's going to be a direct link between higher interest rates and higher cap rates. That's usually the case, but when we look on a quarter-to-quarter basis and by property type and region to region, we're not necessarily going to see this direct upward trend going forward. And as you can see here, when you look at the regions, the Southwest, that includes Texas, Oklahoma, Louisiana, and Arkansas, you can see the office cap rates there jumped. So that could be, say, some large transactions in the Houston market that investors may have not had as much confidence in, or somewhere in Oklahoma. So this chart is made to show you that this is what we're seeing in the trends, but again, there's significant volatility brought about by the types of transactions that traded in that quarter. All of the other regions saw cap rates either flat in the fourth quarter of 2016 or go down ever so slightly. The interesting thing, too, is that the West has lower cap rates for office markets than the other regions. And I think what's driving this is because so much is driven by the San Franciscos, the Los Angeles, and again, the higher-end trades. Looking at other property types, we are showing here the apartment cap rates in blue, the office in red, and retail cap rates in green. And this is the spread, the 10-year Treasury rate spread over time. And as you can see how flat these lines have been. I mean, even on the axis, you see it's only up to 7%. And from 2011 through the fourth quarter of 2016, they really were up and down around about the same rate. But obviously, the office market is generally higher than the apartment cap rates and lower than the retail cap rates. And all three of them showed a decline in the spread, but that's because, as many of you know, the 10-year Treasury rate really jumped in the fourth quarter. And the cap rates didn't really respond in kind, so that's why the spread narrowed. Moving into this last slide, one of our clever analysts put this together just to show the trend in the administrations and the recessions as per the red lines. So the red lines represent recessions, or they're colored in the bars represent GDP changes, but the red ones represent a recession. That's why you see, even though there was a negative bar in the Truman administration, that was because GDP fell, but it wasn't a recession. It was just that the government spending that quarter was not as, or that year was not as, obviously fell after World War II. So what we're seeing here is there seems to be a pattern of an early recession in many of these administrations. And a lot of this, you could say, is a coincidence, or it may have a government or political cycle trend to it. And a lot of people are wondering, well, when is the next recession? It should be coming, if judging by this chart, it looks like it should be coming early in the Trump administration. Right now, our forecasts do not call for a recession. We don't believe in this political cycle per se. And as I mentioned, you can see even in the Obama administration, the GDP bars are considerably lower than the prior administrations, which means because we've grown at such a slow and steady rate, we don't have this over speculation in the market. So we aren't at risk of seeing bubbles popping. So our current forecast is for continued job growth and for occupancy growth, both the office and apartment sectors. Even the retail sector, as much as it's getting so much attention with all these store closures, we see for our neighborhood and community shopping centers, we still see positive, very, very low, but positive net absorption. Our mall forecast, on the other hand, probably shows, definitely shows some vacancy rate increases. So with that, I will wrap up the presentation. So overall, as I mentioned, GDP growth slowed in 2016 after it slowed in 2015, and we don't see the first quarter bouncing beyond that. It should be less than 1%. Job growth should hold steady as well, again at a very subdued rate. Our forecasts have not changed dramatically. We caution that the band of uncertainty is definitely wider, but we still see upward growth in all of the sectors. The cap rates could rise if interest rates continue to grow, but the correlation, as I mentioned, is not as strong. And our economic activity, again, is for, we believe that the fundamentals are still strong for continued growth. And as far as the new administration is concerned, I think we can all agree that there are more questions than answers. So we're just going to have to take a wait-and-see approach. So with that, not sure if anyone has any questions.
Awesome. Thank you so much. If you do have any questions, feel free to chat your question there in the chat bar. Also, so everybody knows, we will be sending out these slides as well. I know we get, I've already had some questions for the slides, but yeah, really valuable. So, anybody have any questions? Awesome. Well, I don't see any questions. Let's see, here we go. Got a couple coming in, so let me just. Okay, so one of a question that just came in: if the positive reflections are right, why are the regulators so upset about multifamily and retail? So obviously, I think one of our clients out in Utah. A lot of this seems like pretty good news. What's the deal with some of these other sectors?
Well, we definitely see more construction in the apartment market. A number of metros will probably see vacancy rates go up across a number of metros. I would say the majority of the metros we track see more construction than demand. But because job growth is expected to be positive, we don't see rents declining in these metros. They just have a very, very low rent growth rate. And a lot of them are concentrated in the urban cores, so you really have to look at the submarket within that metro. For example, in Center City, Philadelphia, there's a lot of new construction concentrated in the downtown area, and we see those vacancy rates going up pretty, not much above 10%, but from about 6-7% to 11-12%. It's not like the office market where it's 15.8% or higher in most metros. The lowest office vacancy rate is 9% in New York City. So it's a different market in the apartments. The vacancy rates are all in the 3% to 6-7% range. Of course, the apartment market is different. The turnover is much higher, so that's why the vacancy rates are generally lower. And rent growth, that was very strong in 2015. It was over 5%, was much lower. It was about 3.4% in 2016, and we see that kind of staying the same going forward. Again, very muted apartment rent growth rate. But and the retail, I just did a paper. So far, we haven't seen too much of an impact on all the store closures on retail rents. There's probably about 13 metros that are seeing rent declines, but even those declines are not significant. They're not plunging. With the malls, it's a story of the high-end malls versus the low-end malls, and a number of malls are definitely hurting. But those that had been doing well are probably poised to do pretty well going forward. And it's really a matter of retailers just staying smart and keeping their stores fresh and clean and better lighting. If there's a JCPenney there, that's obviously going to hurt that mall, or a Sears or a Macy's. But a lot of retailers have been smart. They're putting in different users in their space, whether it's a Wegmans grocery store, or it's a trampoline park, or, there's a lot of entertainment users taking retail space, niche gyms, yoga studios, tutoring, a lot of service providers taking retail space. So our outlook on retail isn't as bearish as a lot of people have feared that it would be, because we still see other retailers expanding. Sports Authority shed 8 million square feet of stores in our inventory alone. But you go on a website, like a Dick's Sporting Goods website, and they're expanding stores. So that's what we're seeing, that a lot of the media is not reporting on. All the retailers that are actually expanding in retail spaces. So our retail forecasts are still probably the lowest that we've ever had, and they're certainly lower than apartment and office markets, but they're not as bearish as a lot have feared.
Sure.
I think a lot, you mentioned the word regulators. I think what's still of concern to so many investors and so many is that it's just been such a long expansion. So any new construction is feared to be speculative and unnecessary. So, it's just something, it's one of those things you have to look at it with a pretty broad mind, that, we're still seeing job growth. And there's, even with the new administration, there's some optimism. Hopefully they will do some kind of infrastructure investment, and, this very slow and steady economic growth pattern should continue.
Cool. They're really helpful. Another question came in, very local question. So I know you mentioned tech companies and traditional types of absorption rates out in Silicon Valley. So a question did come in about that. Do you see any particular issues with office space in Silicon Valley right now?
I know there's a lot under construction. There was just a Wall Street Journal article on it. So San Francisco is, in particular, has a lot of construction. San Jose does as well. I don't think it's as significant as San Francisco. What's interesting is the only two apartment markets that are seeing rent declines are San Francisco and New York City, and that's because of this kind of overflow of new construction. So whether or not San Francisco might see some office rent declines because of all the office construction, it's possible, but I don't see it, I don't see rents plummeting by any means. They're probably expected to stay flat or see low growth as, new tenants move into the newer spaces, but probably vacate older spaces, and then some of the Class B backspace, as it's referred to, stays on the market and drags down rents.
Awesome. Well, I'm not seeing any more questions coming in. Barbara, I'm really grateful for you spending so much time with us this afternoon. Again, if anybody has any particular questions for Barbara, feel free to reach out to us, and we'll make sure we get you her contact information. And again, for REIS, if you're not a customer, they're a fantastic company with great resources and for data analytics, all kinds of stuff related to real estate. So thanks to everybody attending, and thank you, Barbara, for spending time with us today.
All right. Thank you very much for having me.
Okay.
Okay. Thanks. Bye-bye.